tax extenders, provisions that are likely to be passed, with the extension running the gamut from insignificant to highly significant. A number of them are so important that it is inconceivable that they won't get passed. Here are some of the ones affecting people and business in important ways. Number 1, increased dollar limit for Section 179 expensing. This proposed extender would allow taxpayers to elect to deduct up to $500,000 of cost of qualified property, with a phase-out beginning at $2 million. Number 2, bonus depreciation of 50% of property acquired and placed into service in 2015. The additional first-year depreciation deduction is allowed for both regular taxes and alternative minimum tax. The basis of the property and the depreciation allowance in the first year of purchase and later years are adjusted, though, to reflect the additional first-year depreciation deduction. Number 3, shorter S-corporation recognition period for built-in gain. For purposes of determining the net recognized built-in gain, the recognized period is now 5 years rather than 10 years as before. An explanation of this rule: when a C corporation converts to an S corporation, or the S corporation acquires assets from a C corporation in a tax-free transaction, it may be subject to corporate-level built-in gains tax, in addition to tax imposed on the stockholders. Number 4, 100% gain exclusion on disposition of qualified small business stock. The proposed extender extends the 100% exclusion and the exemption from minimum tax preference treatment. Number 5, extension of research credit. For general research expenditures, a taxpayer may claim research credit equal to 20% of the amount by which a taxpayer qualified research expenses for a taxable year exceed their basis amount for that year. Thus, research credits is generally available for incremental increases in qualified research. An alternative simple credit with a 14% rate and a different base amount may be claimed in lieu of that credit. Be aware the credit is not always usable. Number 6, above-the-line deductions for up to $250 of educator expenses. This covers books, classroom supplies, and computer equipment for eligible elementary and secondary school teachers. Thus, college professors don't qualify. In general, unreimbursed employee expenses are deductible only as an itemized deduction, such as Schedule A, and only to the extent that their individual total miscellaneous deduction exceeds 2% of their adjusted gross income. Number 7, above-the-line deduction for eligible individuals for higher education expenses. The maximum deduction of $4,000 for higher education expenses include tuition and fees. In other words, on front of your tax return, there's a place for in miscellaneous deductions for having you deduct your education expenses. Now, the problem is that there's a limitation on how much money you can earn. For eligible individuals whose adjusted gross income for the taxable year does not exceed $65,000, $130,000 in case of joint return, or $2,000 for other individuals whose adjusted gross income does not exceed $80,000 or $160,000 for joint income. Number 8, election to deduct state and local general sales tax as an itemized deduction. This instead of the state local income tax. This is a big one because it is important for taxpayers in states with little or no income tax, and they have a large purchase like an automobile a motor home, or a big furniture purchase in that year to use the amount of sales tax that they paid instead of the amount of money income tax that they paid. Number 9, itemized deductions for mortgage insurance. Premiums paid or accrued in connection with the acquisition of qualified residence. This one is also a big one. Most people put down payments of homes for less than 20%, thus they have mortgage insurance. Certain premiums paid or accrued for qualified mortgage insurance by a taxpayer during the taxable year in connection with the acquisition indebtedness on a qualified resident of a taxpayer are treated as interest that is qualified resident interest and thus deductible. Number 10, qualified principal resident indebtedness exclusion from debt discharge of income. This one I thought we were going to lose, but it's back there, thank goodness. An exclusion from gross income is provided for discharge of indebtedness of income discharged by a qualified principal resident indebtedness up to $2 million for married couples or $1 million for married filing single. Number 11, tax-free charitable donations up to $100,000 from an IRA for people who are 70 and a half years or older. Distributions that are excluded from gross income by reason of the provision are not taken into account in determining the deduction for charitable contributions under 170. What this means is you have a limit of 50% of your gross income for charitable donations for this amount up to $100,000 doesn't count for your charitable donation limitation. Number 12, monthly exclusion from employers provided transportation van pool benefits up to $250. This provision is the same as with employer provided parking. It's like another cafeteria plan. Well, we hope that these tax extenders go through. We're pretty sure they will, and you can start planning your tax return for 2015 before the end of 2015 so you can get your extra deductions in or exclude your income. Good luck.